Hello investors, today we're going to talk about a company that's in almost everything you use, but that you rarely see. It's the backbone of global industry. I'm talking about Linde PLC. If you're looking for a company that survives wars, recessions, and inflation, you need to understand the industrial gas business model. Linde isn't just the world's largest producer of industrial gases, it's an example of operational efficiency and competitive advantage. In today's video, we're going to do a full breakdown, a true deep dive into Linde's investment case. We'll cover the business strategy and why this sector is so special, the robust economic advantage, why customers can't leave Linde, the impeccable financial health and exemplary capital allocation, the debate what the optimists, bulls, versus pessimists, bears, say, and of course, the risks no one tells you about. Go ahead and hit the like button if you enjoy deep dives into global stocks, and let's get to the content. The business model and the industry. To understand Linde, we first need to understand what it sells. It sells industrial gases. We're talking about oxygen for hospitals, nitrogen for preserving food, hydrogen for refineries, and argon for welding. At first glance, you might think, this is a commodity. Gas is gas. The cheapest seller wins. But that's where you'd be wrong. The structure of this sector is extremely favorable. Linde operates with a resilient model that positions it very well to navigate macroeconomic uncertainties. Think about this. Industrial gas, for a factory, represents a tiny fraction of the total production cost, maybe 1% or 2%. However, it's a vital input. If a steel furnace runs out of oxygen or an electronics factory runs out of nitrogen, production stops. The loss from downtime is millions. Conclusion: the customer prefers to pay a premium, a higher price, and sign a long-term contract with Linde rather than risk running out of the product by buying from a cheaper, riskier supplier. To illustrate this resilience, let's go back a bit in time, to 2020 and 2021, during the peak of the pandemic. While many retail and tourism companies collapsed, what happened to the gas sector? Demand for medical oxygen exploded. Linde was crucial in keeping healthcare systems operating worldwide. Even when industry shut down, the healthcare part kept things going. This proves the idea that Linde is a defensive chameleon. It has exposure to heavy industry, but also to essential sectors like healthcare and food, which protects revenue in times of crisis. Linde makes money in three main ways, and it's crucial to understand this. 1. On-site supply, the crown jewel. Linde builds its plant inside or next to the customer's factory, connected by pipes. Contracts last 10 to 20 years. 2. Merchant. Tanker trucks deliver liquid gas to storage tanks at medium-sized customers. Contracts last 3 to 7 years. 3. Packaged. Smaller cylinders for workshops, labs, etc. And here's the magic. The operations are integrated. The large plant, on-site, produces for the big customer, and any excess is liquefied to be sold in trucks and cylinders. Maximum efficiency. Linde's organic revenue growth depends on global industrial production, industrial GDP, as demand is correlated. But Linde doesn't just rely on that. It has been driving growth through new projects, CapEx, asset repurchases, and a huge focus now on clean energy. Just to give you an idea, Linde ended 2024 with a project backlog of $10.4 billion. And guess what? 58% of that value is related to energy transition projects. The economic moat. Now let's get to my favorite part, the economic moat. Morningstar, one of the world's largest analytical firms, rates Linde's economic moat as wide. Why? Basically two pillars: high switching costs and intangible assets. 1. High switching costs. Remember I mentioned on-site supply? Imagine you're a steel mill and Linde's plant is built on your land, with pipes connected directly to your furnace. To switch suppliers, you'd have to shut down your factory, remove Linde's plant, and wait for a competitor to build another one. That's not practical. Plus, there are contractual clauses called take or pay. Here I need to pause to explain the take-or-pay concept. Many investors read this in reports and don't understand the power of this clause. Imagine you rented a beach house for a year. The contract says you pay $5,000 a month. If you go to the beach every weekend, you pay $5,000. If it rains all year and you never set foot in the house, you also pay $5,000. That's take or pay. Linde's customer guarantees a minimum payment to cover the plant's investment, whether they use the gas or not. This protects Linde's cash flow against recessions. If the customer's factory reduces production, Linde still gets paid. Additionally, prices are tied to energy costs. If the electricity bill goes up, the gas price automatically goes up. Inflation is fully passed on. We estimate customer retention exceeds 95%. It's almost like a marriage without divorce. Even in the merchant segment, trucks, contracts are 3 to 7 years, and the customer relies on Linde's tanks. Changing suppliers is a headache. 2. Intangible assets. This involves technical knowledge and patents. Linde doesn't just sell gas, it sells engineering. They go into the customer's factory and say, if you use our oxygen this way, your furnace will be 10% more efficient. This creates value and loyalty. This combination allows Linde to consistently generate returns on invested capital, ROIC, superior to its cost of capital. And we believe this will last for the next 2 decades. Financial strength and capital allocation. It's no good having a great business if management burns through the money. How is Linde doing internally? The company receives an exemplary capital allocation rating. This is largely due to the successful merger between the old Linde, German, and Praxair, American, a few years ago. Since 2018, management has done an incredible job expanding margins. Asia Pacific, 1,000 basis points, 10% improvement. Europe, Middle East, Africa, 1,500 basis points, 15% improvement. Management's goal is to continue expanding this operating margin by about 20 to 50 basis points, 0.2% to 0.5% every year. This is music to shareholders' ears, continuous efficiency. Let's look at the balance sheet numbers as of December 31, 2024. Debt, $21.6 billion. Cash, $4.9 billion. Liquidity, $6.5 billion in available credit lines. Wow, $21 billion in debt is a lot. For Linde, no. Cash generation is so strong and predictable that the estimated debt-to-EBITDA ratio for 2025 is only 1.6 times. This is very healthy leverage for a company of this size and stability. And who's steering the ship? The CEO is Sanjeev Lamba, who took over in 2022. He's been with the company for over 30 years. He's an insider, knows the operation from the factory floor to the executive suite. A positive point, executive compensation is tied to ROIC, return on invested capital, and total shareholder return. In other words, they only make a lot of money if you, the shareholder, also make money. Okay, the company is solid, but does it grow? Here comes the future thesis, blue and green hydrogen. As we've seen, more than half of the order backlog is for clean energy. Linde is positioning itself to be the infrastructure for the energy transition. If the world is going to use hydrogen as fuel or battery, someone needs to produce, transport, and store that gas. Linde has been doing that for 100 years. Our projection for the future, up to 2029, is adjusted operating margin expansion from 28.8% 2024 to 32.5% 2029, organic revenue compound annual growth rate of about 6%. But Linde isn't playing alone. It's important for you to know the rivals to understand the risk. This market is an oligopoly dominated by 3 giants. Linde, LIN, the largest of all, more globally balanced. Air Liquide, AI, the French giant, also excellent, very strong in Europe and in technology healthcare. Air Products, APD, the American company that is the most aggressive in giant hydrogen projects. It's the riskiest and most focused bet in the sector. Linde's advantage over Air Products, for example, is diversification. Linde is more conservative in project execution, which reduces the risk of major capital failures. Bulls versus bears. Like any investment, it's not all sunshine and rainbows. Let's lay our cards on the table. What do the bulls, optimists, say? 1. Unmatched scale. The Praxair-Linde merger created an unbeatable powerhouse in competitiveness. 2. Efficiency. Management proves quarter after quarter that they can cut costs and increase margins. 3. Hydrogen. Linde is the safest bet for the hydrogen economy. What do the bears, pessimists, say? 1. Energy costs and inflation. Although there's a pass-through, peaks of volatility can pressure margins in the short term. 2. Competition in emerging markets. In China and India, local competitors are aggressive and can reduce returns in these high-growth markets. 3. Recession risk. If industrial production in North America and Europe stagnates, Linde's growth slows down. And what about specific risks? Own production. Large customers might decide to produce their own gas. About 30% of the global market is self-produced. But the trend is towards outsourcing, tariffs and protectionism. LIN is little affected by this. Why? Because the business is local. Gas is produced close to where it's consumed. It's expensive to transport gas far. So, import-export tariffs have little impact. ESG. Environmental risks are low. The biggest risk is safety, accidents at plants. But the company has strict protocols. Conclusion. To summarize Linde's thesis, we are looking at a company with a low uncertainty rating, a wide economic moat, a solid balance sheet, and management that allocates capital in an exemplary way. Is it a sexy stock that will double in price in a month? Probably not. It's a stock for those looking to build wealth with security, predictability, and exposure to the real economy and the energy transition. It combines the security of a utility, public utility company, with the growth potential of an industrial technology company. Now I want to hear from you. In the gas duel, do you prefer Linde's stability, or are you taking more risk with Air Products? Or do you think the industrial sector will suffer in 2026? Leave your comment. If this video helped you understand one of the world's most complex and important companies, please consider subscribing. A hug and happy investing.